Good morning, everyone. I'm Greg Faranello, head of U.S. rates for Ameribed Securities, and welcome to Monday Minutes. First and foremost, we hope everyone is staying safe and sound over the next week. 2 weeks are going to be very critical here for the American people in New York in particular. We've been managing this crisis in three buckets: health, financial, liquidity conditions, and economics. On the health side, the governor said yesterday the number of people entering hospitals in New York has increased, but so too has the number of people leaving hospitals. So the next week to 2 weeks will be critical, as there is expectation that New York will hit the apex, and New York still being the epicenter and barometer for the rest of the country. Similar to what the governor said yesterday, we still believe that rapid testing is critical here as we look to come up with a pathway to reopen the economy in the weeks and months ahead, and at the same time manage the health and safety of the American people. With regard to financial conditions and markets, obviously the Fed is still front and center. A ton of corporate issuance in the market for the month of March, which in general was all well received. In addition to that, we've talked about the paring back of Treasury and mortgage purchases. We have seen some dislocations in the mortgage market. The Fed is taking notice. At the same time, balance sheets continue to get cleaned up. Supply continues to get absorbed by the Fed. We've seen roughly since March $800 billion in purchases from the Fed, which in context is more than all of what we saw in QE2 in 2010 and 2011. So based on the schedule from Friday, I expect the Fed to pare back on their purchases this week of Treasury securities. U.S. funding markets, again, reverse repo facility still being used, but to a lesser extent, cash back to the Fed for collateral. And at the same time, we've seen a deluge of short-end paper last week. Cash management bills, Treasury bills. If you look at the Treasury's general account, now $500 billion versus in September of 19, where we were under $150 billion. So supply is still going to be in the marketplace. You look at the CARES Act, you look at the demand for some of these loan programs, unemployment insurance, checks going to individuals. The Treasury is going to look to keep that account flush, and we still expect supply to be a factor here going forward, particularly on the short end. Demand for money market funds, T-bill yields now all positively yielding as we move forward here in 2020. On the economic side, obviously the claims number is still front and center. Friday's employment number largely irrelevant. The claims number will still drive the process. We'll be looking again this week. All eyes now on the lending programs out of the Fed. A small hiccup on Friday, but let's stay positive. Keep in mind, these programs are difficult to administer. They are going through the banks in many cases, which banks have to follow standard protocol, whether it's AML or KYC. There's still a little red tape to work through, but the emergency loans are available through the SBA. Very seamless process to apply online. And with regard to the PPP, the best course of action is to find your local bank, find your bigger bank, find your banking relationship that you've done business with in the past. The bottom line here is these kinks will be worked out, and what's critical now is that we take this money and we find the right home for it on a short-term basis and mitigate job losses. I'm Greg Faranello, and this is Monday Minutes.